Howdy, Jacob here. Today we're looking at Biogen in the biotechnology industry. 33 billion market cap on 38 billion enterprise value. They discover, develop, manufacture, and deliver therapies for treating neurological and neurodegenerative diseases internationally. I think recently, maybe well, not recently, maybe 3 years ago, 4 years ago, I remember looking at them. I think they dropped a bunch because one of their drugs or two of their drugs went from specialty or preferred to generic. And so I think that hindered their revenue quite a bit and more so their margins, which we can see from what we're looking at here. They're going to have to really, we're going to want to see a lot of R&D here because one, their margins are already hit. So we just want to see future possibility and likelihood for future growth. So this is where if the company looks like a decent price, we're definitely going to have to look at the 10K, 10Qs and make sure that the companies are they have drugs at certain stages that are likely going to be coming due soon, so that they can start making some money because this is not looking pretty. I mean, from 2014 to 2019, it looks great. You're looking at about 8% a year, 9% a year, and then just boom, it's dropped 8-9% a year. So not looking super pretty. Currently, gross margins down from 88% to 74%, operating from 40% to 19%. I mean, if they can get back to that 40% range, this is likely going to be a screaming deal at this price point. But we just you we just don't know that yet until you do more research, until you do your initial analysis, and it makes sense for you to do a deeper dive. But return on invested capital historically fantastic. Currently down quite a bit from their operating profit being down quite a bit. Their balance sheet shows $1 billion cash on hand, no short-term debt, but $7 billion long-term debt. So they do have a little bit of debt here. It doesn't look like they've really dwindled that down that much from the last 8 years. Cash flow statement shows a huge acquisition right here. Maybe some investments, maybe some devastations. I mean, acquisitions and share repurchase. It used to be share repurchase. They used to buy back a bunch of money. Everything they made, they just threw into share repurchases. But for now, in the last couple of years, it looks like share repurchases have dwindled down, majority going to acquisitions, maybe a little bit to reinvestment. To me, if I were this company, let's see what their 5-year average free cash flow is. So, I mean, you got as high as 6.5 billion and as low as $1 billion. So maybe $2 billion. I mean, $2 billion with a $7 billion long-term debt. You're really not concerned about that. So maybe you just focus 10% to that debt reduction, and then maybe start focusing a little bit more on share repurchases, and then the rest, maybe 50+%, can be for reinvestment, acquisitions. Let's look at that R&D spend that quick on the income statement. So we are seeing higher R&D spend than 10 years ago, but it is down a bit from COVID. I think that's fine. I mean, they're still getting hit with margins and still investing $2.3 billion in R&D. I think that's still a good amount. That still should lead to future growth. But again, we'll have to see whether they're doing well at getting those drugs from null stage to stage 4 and ready to go. So let's start making our assumptions here. I think if you know this business better, you're going to make a lot better assumptions than I am. I will be making assumptions based on what I'm seeing here. I think that they can get back to 3% growth. And if they do, I think that they deserve a margin there. I'm going to put a 1% increase than I usually do for the discount rate because I'm making some assumptions here I'm just not entirely confident in. I think I'll do pretty close to an average here due to the fact that you got some high, you got some low. Maybe I'll do a pretty wide range of 28 to 32%. And then for the share change, 1% would be about 330 million. Offset sideways compensation, about 600 million. I mean, I think that seems somewhat reasonable. Maybe let's be generous. Let's be a little bit conservative and say 0.5%. That's saying about maybe 25% going to share repurchases, a little bit to debt reduction. Then we're leaving 70% to just get back to some positive growth, get back to some earnings margin, profit margin here through acquisitions, through reinvestment, just making some of those drugs specialty or preferred that just have those higher margin things that really just takes that front end investment to get, almost 100%. I mean, not 100%, but almost 100% margins there. So really, with these assumptions, we're saying the company's stock price needs to fall 42% to get to the return we're looking for here with a slight margin of safety. I think that really the whole investment thesis, if you were to invest in this company, is just, will they get back to those margins? Will some of their drugs start getting back to profitability? Not profitable. They're still very profitable compared to the average company, but will they get back to making specialty drugs, preferred drugs that have a 7 to 10 year horizon on them? And I think that'll give them future prospective growth. Will they'll be able to give a lot of money back to you as the shareholder? But for now, I think it's definitely in a down, which could make the stock cheap right now. I mean, that could be a possibility, but for me right now, it doesn't look so obvious that I need to do more research immediately. So I'll just wait until it becomes entirely obvious. So I do hope you enjoy the video. Have a great day. Thank you.